While headlines continue to focus on Trump's first weeks in office, as well as the wild swings in tech stocks, another story is unfolding in fixed income. High-yield spreads remain surprisingly stable. The 10-year Treasury yield flirts with 5%, and investors face a crucial question. What is the bond market telling us about investing in the year ahead? Well, we're going to break that all down for you and more right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. My guest for this next few minutes is Leslie Falconio, the head of taxable fixed income strategy with the Chief Investment Office Americas. Leslie, great to have you join us on the show today. It's been a very long January as we got through the month. So much has taken place between the inauguration, executive orders. Most recently, there were tariffs that were announced from the U.S. to Canada, Mexico, China, and vice versa. There's some retaliatory comments that are happening. So I want to get your thoughts on how the fixed income market has been doing. We're looking right now at a 10-year yield that's around 4.5% or so, but not after hitting a high in the middle of the month, or I should say a 52-week high, that was closer to 5%. And we also had a Fed meeting. There's just so much to unpack. So just digest that for us, Leslie. What are you really looking at right now?
Well, let's first, and you're right, Anthony. There was a lot to digest these past couple weeks, and particularly these past 3 days. So before we even talk about the January performance, let's talk about what's happened since from Friday till now in regards to some of these tariff announcements. I mean, the yield curve in the 10-year Treasury has been in this 430 to 480 range. That's our range for the 10-year Treasury yield over at least the short term. Now, as you know, our recommendation has not been to really extend that far out the yield curve, simply because we weren't sure what kind of policies were going to be implemented. The growth picture still looks very strong. So we really wanted to stay in that 5-year part of the curve. But since we've had some of these announcements, we've seen a couple things happen. I mean, one is we're still not sure, when these announcements will be implemented, or the duration of those tariffs, for one thing. But the yield curve today is doing what it kind of did back in the previous Trump term, in that it is what we call flattening. And what happens first is that when you have these kind of tariffs sort of play into the marketplace, the market thinks first inflation. Right. So even though these might be one-offs, even though the Fed might look through at these one-time price increases, the market, doesn't price like that immediately. So what happens is that we have what's called a yield curve flattener, and that short end starts to rise because the market takes out cuts. Now, you mentioned the Fed meeting. Now, after that Fed meeting, which is an on-hold Fed, data-dependent Fed, a Fed that had 2 cuts priced in, the same as CIO had. But now we're seeing the market sort of even take out those 2 cuts. So on Friday, we had like a 90% probability of 2 cuts for 2025. That's down to about 50%. And most of that has to do with the fact that inflation expectations, particularly in the short end, are starting to rise. I mean, for example, Anthony, you have inflation expectations from this tips market, say 2-year tips, break-even inflation expectations, and 1-year tips at the end of the year were about 2.5%. They're about 3.5% now in the short term.
Mm-hmm.
So you have these short-term inflation expectations rise, which takes cuts out of the marketplace, and the yield curve flattens. But that's just the short term. The second order effect is when they take a step back and say, okay, wait a minute, this is going to impact growth. And this is going to be a headwind to growth. And it's at that point in time, with this just sort of the second order, you start to have what we call a bull steepener, meaning that the market says, okay, growth is going to slow. These tariffs are going to be a headwind to growth. So therefore, the Fed will cut, right? And you have this sort of what we call a bull steepener. Now, we're in that first phase now. We don't know exactly what's going to happen in terms of, again, policy implementation or the duration of those policies. But right now, the curve is a little bit flatter. As you mentioned, we're doing about a 4.5% in 10-year Treasury yield, which is really kind of in the middle of our range of 430 to 480. So we don't chase the market here in terms of, say, buying. We wait for the extremes. You buy as you get close to 480, and the other part, sell as you get to 430 on the 10-year. And one thing I just want to mention really quickly, Anthony, is that when we look at these 2-year yields, because we have the 2-year yields moving higher because they're taking cuts out. We had a high last night of about, I think about a 428 in 2-year yield. The effective funds rate right now is a 433. The closer that 2-year yield gets to that effective fund rate is really when you should also start buying because it's not our view that the Fed hikes this year, right? So having the 2-year well above the Fed fund rate is probably unlikely. We look at that as a buying opportunity.
Leslie, I want to take a second because I was reading your fixed income strategist from January, so it was released about a week after the new year. And you had said in there that a policy rate of 4 to 4.5% remains a restrictive level of interest rates and a headwind to growth and inflation. Is that still the case even now that we know more about these tariffs? How, it's month to month, things change so much. I just wanted to get your thoughts on that.
That's on real yields. So we know what we've seen, what we saw to your point, and you mentioned this earlier, we saw 480 in 10-year treasury yields, right? And we have a lot of those, what we call those bond vigilantes waiting for this, 5% in 10-year treasury yields. But we saw the 480 in 10-year treasury yields. But what the push to that was the rise in real yields during January. And that real yield rise was because of growth. We had strong growth numbers. So in our point of view, when you think about like, what could be restrictive or what could tighten financial conditions, it really is if that real yield excuse me goes above that October 2023 high of 4.5%. Now in terms of the nominal side, you'd really have to see nominal 10-year treasuries in our view go above 5%. And even if it's growth driven, like even if we just have strong growth that people weren't anticipating because the consumers remain so resilient, and we saw some strong consumption numbers from that GDP that we just printed on Friday, even if it's growth driven, having that over 5%, I think might cause a little bit of headwinds to performance and lower credit quality simply because they're so tight at this time.
What about high yield, Leslie? This is a really compelling story because high yield looks relatively cheap compared to equities. Would you view that as a positive, or is it maybe a pocket of vulnerability that's ahead for investors?
Yeah, I mean, that's a great point, Anthony, because look, the lower credit quality, like high yield, has been so isolated from volatility. And it's not even just from like tariffs, it's what we've seen in terms of the tech volatility that we saw in the equity market. Now, granted, the composition of the S&P and the composition of the high yield index are different, right? Because the composition has evolved over time in terms of the S&P. But you've really seen some very low, what we call spread duration, meaning spreads aren't really moving that much. And even though we had very low supply in high yield in July, you just have this large demand from investors in terms of wanting to get that carry, in terms of earning that yield. So listen, a high yield, in our opinion, we're neutral on the sector. We would opportunistically add, but not at these levels, only because more than likely, given the uncertainty of policy ahead and given some of the volatility that we'll see, they're due to have sort of a bout of correction. And when I say that, I'm not saying there's going to be some sort of catalyst because we think defaults remain very subdued. Corporate balance sheets still remain strong. You're getting a very good carry at high yield between like 7.5 and 8%. But in a spread perspective, to go into lower credit quality, we're just not allocating to that right now. We would prefer like the higher credit quality in terms of investment grade corporates. So we look for pockets of vulnerability within high yield, but we look at that as opportunistic versus having some hard landing or a catalyst in terms of high yield balance sheets.
Right. And then back to the 10-year for a moment, since it is the benchmark, and you've already talked about how it's pretty range bound, 4.3 to 4.8%. The question that comes up, I'm sure you're hearing, is could it reach 5% again like it did, about a year and a couple of months ago? First of all, what would be the impact to risk assets under that scenario? And given that we have a little bit more color on some of the market sort of volatile moments from Trump 2.0, which are the tariffs, which also are immigration and trade tensions, there still are things that are coming down the pike like tax cuts and deregulation. How does that all play into what you're thinking about the yield on that 10-year treasury?
Yeah, I mean, listen, we're asked all the time, could we see 5%? And there's no question that we could see it. But it's really a question of sustainability. Now, if we have a reacceleration of inflation that's beyond the tariffs, that's due to wages or shifts in immigration that causes reacceleration that lasts, a long period of time, then you're going to have what we call this back end start to really rise. And we all talk about these bond vigilantes in terms of the deficit. And it just so happens we have the refunding announcement this week, which we really think is going to stay on schedule, right? The borrowing capacity of the government is more than ample right now, and that supply is not expected to come till the latter part of the year, like late summer or the fall. So, in order to see that 5%, which you absolutely could, growth could be much higher than expected. on top of the supply, a reacceleration of inflation on top of the supply could push that 10-year to that 5% or slightly above. But that would be a buying opportunity. And the reason why we just don't think it's sustained is because how fully valued both equity and fixed income are, and how and how people are positioned. So when you move over that level, even if it's growth related, which would be a positive, I still think that the fixed income market is having a difficult time adjusting to that new level. I mean, the fixed income doesn't like the unknowns. If you go above the level that you saw in October 2023, you're still going to get, I think you're going to get some pullback and some spread widening in risk assets. And I also think the equity market will have a tough time adjusting that as well. So could you see it? Yes, we would buy it because we just don't think it's going to be sustained.
You still like that 5-year part of the curve, though, right, Leslie, as far as CIO's base case is concerned?
Absolutely. I mean, the 5-year part of the curve, taking on that kind of locking in at these yield levels for the 5-year treasury, which is not a huge amount of interest rate risk, but you still have the ability to compound that income, and you have a cushion that the 5-year treasury would have to increase over 120 basis points for you just to break even. We think is a really good part. And there's a bit of safety there as well, particularly now that the market is only pricing in less than 2 cuts, right? So you have this hawkish kind of view there. It's not pricing in the potential of slower growth. It's not, pricing in the potential that, you know, you might have a correction in the equity market, or the Fed's going to have to cut more than 35 basis points that it's currently pricing in. So we really like that 5-year part. It's a great way to lock in terms of yield, get that compounding income, but not go too far over your skis in terms of interest rate risk. We would wait for the 5% 10-year Treasury yield before we did that.
Great, Leslie. Yeah, and obviously we've got a lot more important economic data that's going to be coming out over the next week, 2 weeks, 3 weeks that the Fed is really going to be focusing on. So a lot more to come there. So as we're wrapping up, Leslie, I always want to make sure that we give our viewers your position on where you think the best parts of the fixed income asset class sit right now when it comes to sort of the unknowns of policy and what's the impact to the fundamental data. Where are you recommending people should be putting money to work right now?
Yeah, I mean, listen, you know that in our portfolios, we have the most attractive on the equity market. We just talked about how tight high yield is. And it's not that we think, again, there's going to be a catalyst, but those two sectors are correlated. So we're going to take our risk there in the equity market. In the fixed income side, right, because of the equity most attractive, we're going to go into the higher quality. And the higher quality being agency MBS, IG corporates, even munis, and even part of that floating rate in terms of senior loans as sort of what we call a hedge now that we think the Fed it could be and will be if what they're stating is higher for longer. But most of it is still in this higher quality sectors because, again, there's a lot of optimism priced here. There's still a lot of unknowns, and there's no reason to take on, really deep credit risk given the fact that you're earning very good incremental yield and higher credit quality.
Excellent. Leslie, thank you so much. I'm always great to have you, and I know there's a lot of conversation that we'll be having over the next few months into the year when it comes to the markets and all of the unknown variables in front of us. Great to see you. Thanks for joining us, Leslie.
Thank you.
Great. And for more information from Leslie and the rest of the Chief Investment Office, visit our website at ubs.com/views. Plus, you can follow UBS on social media on all the major channels like LinkedIn, X, Facebook. We're also on Instagram. Follow us at UBS Trending. Lots of studios content there for you to take a look at. And as always, if you have any questions about what Leslie and I spoke about today, make sure you're chatting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon. Thing